you, Paul, and good afternoon, traders. Thanks again to ICE and to Ninja Trader and, of course, Trader Kingdom for having me back this afternoon. And thank you all for your attention and for attending. What we'll do, and we've already got a question here, but what stocks do we look to buy when the correction is over? So to kind of be timely here, the S&P and the Russell and NASDAQ and all those things are retracing, pulling back to support. And the markets are getting much more volatile, choppy, all these sort of things, and news headlines all over the place are, some are bullish, some are bearish, all those sort of things. But what I wanted to do, and what I'm honored to be here with you this afternoon, is to step back, pull the perspective back, get out of the noise, get out of all these things, and focus on price patterns. Focus on what works, what's been time tested, what the founding fathers of technical analysis have really just given us in the form of pre-computers back in the 1920s, 30s, 40s, so on and so forth, with Edwards and McGee, Schapacker, even Charles Dow. And so what we'll do is take those patterns from the description. What we did is taking these classic patterns and we're going to put them in today's context. So what we'll do is discuss entry, recognition, management, and exit. And the pattern works or it doesn't. It has probability of working, and the stop loss will always be smaller than the target. So that's going to help us put our structure, put our trades and trading plans and all the things that we do in these probabilistic, not certainty terms. It steps us out of the noise and really gives us a foundation to build whatever we want to, whatever indicators, whatever aggression or conservative or risk-seeking or risk-averse or the currency markets, the S&P, crude oil, leading stocks, options, so on and so forth. But these foundational patterns, these core foundational building blocks of trading strategies, they've stood the test of time, but you can't just pick up a textbook from the old days and expect it to work in today's markets. There's a little bit of tweaks and a little bit of attention we have to pay, and things have to adapt really to today's market. So again, thank you all for having me. Thank you for attending, and let's go ahead and jump into our presentation. So all trading, wish we could jump in here and make a bunch of money, but all trading does involve risk. So price patterns, I think, help step us out of the noise and out of the confusion and at least give us a pathway. We call these price pathways to expect and to recognize, and how history, as technical analysts, tend to repeat. And that's the kind of foundation we're building here. But all trading, just as a disclaimer, does involve risk. We're playing probabilities. We're not playing certainties. And just quick, I want to thank Paul for the introduction. And just quickly, I started my trading career or investing career, as most people do, sort of an investor, Warren Buffett style stocks, those kind of things. And as the bear market really was in full swing, 2002, I started turning to technical analysis as a way to sidestep these bear markets and to stop buying stocks all as they fell and fell lower, and better fundamental valuation when the price goes down, all those sort of things. To me, technical analysis was a solution to that problem of buying a stock that just kept falling and feeling good about that, which isn't good to lose money. So TA, technical analysis, was that solution for me. As I became more proficient, as I really enjoyed the materials, the patterns, indicator strategies, I became a full-time trader in 2007, and as a swing trader, it doesn't make much sense to be a full-time swing trader. It makes more sense to turn to the lower time frame. That's what I did. That's what I've done to this day. And as Paul mentioned, I have a Chartered Market Technician designation, CMT. I took a grad, so there's a couple of questions about that coming in already. But it's kind of like a grad degree. Just picture it like a grad program, a 2-year program with 3 examinations and sponsorship and reading these books that I'm going to sort of summarize for you today, and the patterns, etc., and put it all into a strategy. But as a trader, we like to keep things simple, so don't get too complex. So if you're new to trading, welcome. Welcome to this new and exciting arena. And I moved from Alabama to Los Angeles, California, where I am now, and happily living just south of Hollywood, living the dream here. It's amazing. But trading was able to accomplish some of those goals for me. And I'm the author of the Complete Trading course from Wiley. So, okay, all that being said, let's jump in here. And I do want to keep this interactive. So we'll have 3 patterns. We'll have typically a brief. Any kind of questions that have come through, I'll pause and answer those in the presentation. So don't fall asleep. You keep your attention here. This is fun material and it's working. So let's go ahead. So why are price patterns useful or helpful? Why do we care? In this grand arena of quantitative analysis and algorithms and any indicator you can imagine with NinjaTrader or any other any other kind of charting platform you can imagine, there's hundreds if not thousands of indicators. Why do we look at price patterns? Well, let's learn that. We'll study that in the course of the presentation. They don't require complex indicators. They don't require complex strategies. Anybody can see them if you learn what the patterns are and what moves the patterns, which is just supply-demand differential, bull-bear balance, that moves price. Simple, easy, and they all have a built-in entry, target to play for, stop-loss, and, of course, the management strategies. That's all built in the patterns. Patterns refer to triangles, rectangles, head and shoulders, wedges, flags, double tops, double bottoms, all those sort of things you may have heard of or may not have. And as this presentation goes in the first presentation of the Technical Traders Forum, let's just assume that we don't know that much about technical trading strategies, and we'll keep it simple and build from there. So as you progress in the series or in your trading career, build on this foundation. And it's just that when you're putting positions on, it's the components: recognition, entry, management, and then exit. That's really what a trade is. So keeping things, again, basic here, the three foundational setups that you'll always take no matter what style you settle on as a trader, be it intraday, be it swing, or whatever the case may be, there will be three foundational setups. Those are, on the left, pro-trend retracement trades. That could include flags or breakouts. Breakouts would be next. Breakouts are simply a movement up above a resistance level or down beneath a support level. For our purposes today, we'll talk about triangles as a consolidation and breakout trading opportunity. And those people who just can't resist calling those tops and bottoms, I'm one of them sometimes, not much anymore, but tend to go with the trend. But as a build your trader toolbox, you'll need to have these positions and these strategies in them. And it's for reversal trades. And we'll call this the three push pattern and head and shoulders and double bottom, double tops, triple bottoms, triple tops, all those kind of things. And Lee's asking, is there any way to know if there's a false breakout? My goodness, no. There's little clues we can take a look at, and I'll actually go, that's part of the presentation, is failure outcomes and traps. Sometimes traps lead to bigger moves in the opposite direction. So what we'll do is learn the core pattern and then take it a step further and say, oh, they got us, little markup participants and whatever, did a trap, and so that leads to bigger moves. But we'll start with the core and build off of that. Every single price pattern that you'll ever do, and for that matter, every single trade that you'll ever take is going to fall in the context of one of these three. Either a retracement, a breakout, or a reversal. And there's little metrics and methods and strategies and tactics and techniques that are unique to each of these. So just kind of keeping it simple again. Every single pattern has these components. And as we go through the rest of the presentation, that's what we'll focus on. Recognition. That's the fun part. Trust me, it's a lot more fun to recognize these patterns in real time. That is a skill that takes, there's a skill that definitely takes practice in doing this. Entry, and so that's going to be the actual trigger into the position. The initial stop and target, that's from the pattern. That is actually the, there's actually a inherent, built-in, crystal clear, every time a pattern forms, there is a stop loss level. There is a target to play for. And all our goal is, from that point, all this is recognition of the pattern and understanding of these patterns, is simple management. But that's where it all goes wrong. Oh my goodness. We second guess the market. We don't trust the pattern. We don't trust the strategy. We think, oh, well, they're going to get us this time, or here we go again. And the stop may be hit, but we keep holding the position. So This management function, management portion, is what separates those that are good at trading these patterns versus those that have trouble, have a little bit more to learn about these patterns. But keep things in terms of objective. What that means is if I see a flag, you see a flag, it is a flag, and it's not anything subjective to it. Just following these rules, that's what will help us in our analysis and trading methods. So speaking of, we'll start with a classic flag, one of my favorite patterns. I've done a lot of work with this and had a lot of trading success with this simple pro-trend retracement pattern. The expectation is that the trend will continue. So when you see a trend in motion, price making higher highs and higher lows, and you see a pullback or a retracement, we can quantify it sometimes as a flag, and we'll define this, and that suggests that higher price highs are yet to come. Or in a downtrend, lower price lows are yet to come. So let's go ahead and define these things. Oh, if you are new to trading, I would focus your attention mostly on this pattern. If you're confused or uncertain about where to begin, focus your attention on pro-trend, trading with the trend, retracement style strategies. It's the good reason I started with this one. It begins with a large impulse. It's just a straight up or angled price movement on the chart. Very easy to spot. We look then for a retracement, also called a pullback or a flag. And we'll take a look at the pattern shortly, but the flag would just be a contra move. If the price is moving up, the flag will move down, just like an actual flag. So if I kind of cover the chart up here, ignore this measured move part, this is what a typical flag would look like. Just a regular, good old flag. But what we do from this point, from a trading standpoint, is project. We trade what's called, in our trading terminology, a measured move. Measured move. It's basically taking this pole, let me draw it, this pole, copy and pasting, or drawing it by hand, or whatever the case may be, from the bottom to this, the copy and paste. Copy the bottom, paste on the lower side of the flag as price moves up. And a question comes in from Meso, how do we measure the bottom of the flag? We'll talk about that shortly, but when price breaks above this falling upper trend line, we can be confident that the flag bottom is in play. So sometimes we also look for what's called an ABC structure. Well, we'll just see it on the chart. We won't worry about this. But this is a particular, I guess, an ideal measurement of a flag. The target is simply the measured move. So it's right at the top of this projected pattern. The stop, once the price breaks above the flag, the stop will then go underneath the price low. Those who use Fibonacci can use that, but we're keeping it simple. So advanced traders would use Fibonacci to find the bottom of the flag or potential bottom of the flag, and also to place stops. Otherwise, wait for the price to push above the flag high. Don't try to call the bottom if you're a new trader. So keeping that in mind, we'll kind of break these entries down with respect to new traders or conservative traders and aggressive or more experienced or advanced traders. So again, these flags are called retracements, and an aggressive trader is trying to find the bottom of the flag. That's much more difficult, so new traders should not try that. But if so, for kind of tips for the future, you can use trend lines, moving averages, or Fibonacci retracements. All of those are potential spots where price will hit and then trade up off of. If you are a brand new trader, don't think about that whatsoever. Don't try to call the bottom of a flag because it could just keep falling and hit your stop and frustrate you. So don't do that just yet. Start your trading journey on a good foot and wait for price to break above the falling trend line. And again, that's an only rule. And you just draw this on your chart by hand. It'd be nice if the charts do trend lines for us, but we have to do a little bit of work in our trading. So look for that price to break above the falling trend line. At that point, you can place your stops. So that's, again, an aggressive, experienced, conservative, new strategy. So here's how that works. This was going back to the Russell 2000 index here in 2013. Really the majority of 2013, this big flag played out. This is a prevailing or occurring uptrend. The price is going up. It's making higher highs and higher lows. The price makes a sustained or continual big up impulse, big movement from about 870 to about 980. That's about 100 points. There's our, and then try to go with me in real time. Pretend like we don't know the future. So kind of pretend like we're just looking at this in real time. So there's a 100-point Russell movement. Here is a consolidation. It's ugly, it's nasty, it's choppy, it's messy. That's okay. But it forms a bottom into the prior high. Remember we talked about a trend line? This would be a trend line. So the price is pulled back to a trend line potential support area. If you are an aggressive and experienced trader, that is where you would look to enter, and you would place stops underneath that level. However, if you are a more conservative or a brand new trader starting your career and just looking at these patterns, you will not look to do that because the price could just fall right through. So when the price breaks above a trend line, odds start to shift very distinctly to the bullish side. That's because short sellers, those who think the market is going to go down, will be caught, they'll be trapped, and they'll be forced to buy back their losing positions, especially on the break of a trend line or a break to new highs. Keep that in mind. So short sellers, when they are wrong, when their stops are hit, they have to buy to cover. At the same time, other traders will similarly be buying and entering new positions. This creates what we call a feedback loop. In other words, bears are buying to cover their positions. Bulls are buying to make money. And just like the pattern suggests, the end result is typically a measured move from the bottom of the flag to the high. It's just basically a market impulse movement. And here's your retracement flag. Your stop would go underneath this point, especially if it breaks with the trend line, and you're playing for this target. It's about 100 points. So from about 1930, 1920 to about 1020, 1030, thereabouts. And that's what the market ended. Actually went above that level. That's good. And you'll exit. We don't expect more flags or not patterns that cause us to hold forever. We'll take that position and get out and be happy and look for the next pattern. Similarly, on the dollar index, we'll jump intraday here. This is going to be about September 2014, so last month. This is a consolidation. It's still uptrending, higher highs, higher lows, higher highs, higher lows. But there's a breakout. There's a breakout above this 84.90, 85 level in the dollar index futures. This led to a pull, boom, of about 70 cents for the contract. Here's your flag. It didn't really end on a key level, not really. So, and besides, the movement intraday is a lot quicker, faster, more rapid than the daily chart. So I'd just say for both traders intraday, or both traders aggressive and conservative, we'll wait for the price to break above the falling trend line. That triggers us in. It puts a stop 20 to 30 cents lower, depending on your aggression level. Typically, wider stops are preferred, but some traders that are new just don't handle or can't handle the volatility of the wide stop. That's fine. There's not an exact to the point, to the penny level, but just the wider tends to be better if you can handle that. And again, same thing. Add that pull to the low of the flag, and that takes us up a little bit higher than 85.80, about a 70-cent move. Get out. You can actually set these targets in advance. Take the stop or take the exit, and that's the trade. We don't have permission, don't have odds or probability to hold on beyond that. One bigger one, I've used this multiple times in presentations, actually in the book too, because it's such a cool pattern. it's going back to 2009. So we're kind of quickly on this one. This just shows you, once you understand the basics, the core of the flag, you can add in little variables here and there to make the probabilities a little higher or to increase your confidence of taking a successful trade. Sometimes confidence is what matters. We can see these things all day long, even in real time, but we have to have confidence that we'll put the position on and manage it. So similarly, here's your down move, down impulse. It's about $7 in the index. Choppy, choppy, choppy move up. Going advanced with us here, but this is the 61.8 Fibonacci retracement from the top to the impulse low. Basically, you're taking the Fibonacci from the high of the flag of the pole to the bottom of the pole. And you're looking for the flag in real time as it does this little wave and chop things to end at one of these levels, 50 or 61. This, again, is an advanced concept. If you are not an aggressive trader, this is not going to come into play. You will enter on the breakdown, and that's it. If you're aggressive and experienced, this gives you a little bit more probability to tag the market at a little bit higher level and place your stop a little bit closer. Otherwise, you'll still enter on the breakdown and target the $7 move. And that was about 80, and that's the market movement there. So that's flags. And it's a couple questions that came through, but as we go to the next section, is there any questions so far about flags and methodology and tactics and entry or anything like that? I was asked about the current market. Definitely. At the end of the presentation, we'll talk about the current market. Lots to talk about, my goodness, today. This week, actually. Garth asks, what is the best time frame for trading? My goodness. I would recommend sort of a similar progression that I did, and that most people that I've spoken with do that. You typically start at a bigger frame, daily charts, be a swing trader, those sort of things. And what winds up happening after that is as you become more professional and experienced, you wind up dropping your time frame. If you're full-time, definitely go in a lower frame. You don't really want to, I'm going to go back and see the other ones. You don't really want to trade a swing trading basis if you're a full-time trader. That doesn't make much sense. You also don't want to trade intraday if you have a full-time job. That doesn't make sense either. So match your time frame, your trading style, what charts you look at, how long you hold a position, how active your trading is, based on your own personal situation in life, and of course on your trading journey. Yeah, this is Tom asked with the 310 oscillator. It's just going one step further. This is Linda Raschke's 310. It's a momentum oscillator, like the rate of change. And what this is saying, just kind of a quick bonus, I just want such a cool example, is because this high, price made a higher high into a resistance level with a negative divergence. That just adds one more piece to the puzzle, like if you're a detective or something, that odds favor a down move. And the 310 oscillator, rate of change, volume, market internals, all those things would have been effective for calling the top of that flag. And I think Lee asked, the prices making the pole are usually long candles. For the most part, Lee's asking, the prices making the pole are usually long candles. Yes, that's impulsive. In an impulse, these are on the daily chart, these are intraday, each day. That's what we're looking for. We're looking for a market in motion, a market movement. We're looking for one side to be decimated, essentially. In this case, the bears or the short sellers, because they're having to take action. They have to do something. They have to get out of the market. Otherwise, they keep losing money. On the flip side, bulls or bears, they want to get this perfect little breakout here, but if they miss the breakout, they have to kind of clamber over themselves to get in the market because they'll miss the position, whatever the case may be, especially in currencies. So what happens is this type of pattern, this almost piling in of money into a movement up or down, for that matter. Flags that go down tend to be quite violent because these are pro-trend patterns. This is going with the trend as it exists at the time. And that leads to what we called earlier, a more complicated terminology is feedback loop. That's where higher prices literally cause people that take action, or funds, or algorithms, whatever, to take action. So higher prices causes these things to trigger stop losses. It causes bulls to get in, and as a result, both on the retracement and the pull and the measure move, you do see these big candles. So I have a good question, absolutely. How accurate should the trend line be on the flag? I would say if you lean toward perfection, trading is going to make you frustrated. If you lean towards just kind of an open mind and getting the pattern right, which is a supply-demand differential, getting what's going on in the bigger sense, not so much, oh, look, it went out of the flag trend line, it's the pattern's invalid, or I'm sure you could see any number of things. Oh, 2 times here, it jumped out of the trend. That don't be perfect when you're drawing trend lines. That same thing here. The rule, and we'll see this next on triangles, so we'll kind of use that for the next session or section. But for trend lines, if you look back to Martin Pring or Edwidge and McGee and Schabacher and really anybody that teaches trend line in terms of classical trading strategies, is that you want to sacrifice perfection for kind of not so much accurate, perfection for what's real, what's happening. So what that means is gather the most points as possible. As many times as possible, you can draw a trend line by hand that connects or touches as many price points as possible. That's more valid than if I chose to draw a trend line from here. Let me draw a drawing line. Let's see. Say from here down to there. See this trend line here, even though it went up above the trend line, that's only 1 point versus 1, 2, 3, and then 4. So, and the same thing down at the lower. So when you're drawing trend lines for any type of pattern, don't try to be absolutely perfect. Give some leeway. There isn't anything magical or ethereal or spiritual or whatever the case is, like Fibonacci. The market must nail a Fibonacci level. It's magical, and that's not the way it works in the real world. Give some leeway to these when you're drawing trend lines. Triangles and flags, all those kind of things. Oh goodness, lots of questions. Lots of questions coming in. Do I wait for let's pick a couple more, then we'll kind of move on. I'll get the ones at the end of the presentation. Does the flag work in a downtrend? Yes. The oscillator is the 310 oscillator, but let's not get caught up in that just yet. Risk, reward, and flags. We can see sort of going back. You're looking for about a 2 to 1, 3 to 1, 2.5 to 1. In this example, 70 and 20. That's about a 2.5 to 1. You're risking about 20 cents. So on the downside here, that's your risk. To play for about 70 cents. You're entering at this point, you're playing for 70 cents if the thing works out perfectly, which again, textbook examples do, but in real time, you have to manage these things. So that's your target, and your stop would be about 20 cents in that example. Otherwise, go back. This would be about 100 points of a flag and about 30 to 40 points. Well, actually, this would be lower, 20 points if you got the inflection. A little bit higher if you're above that and playing for that move. So where you enter determines what your risk reward will be. And what that means is if you enter on the top, which conservative traders should do, they'll be a little bit further from the stop. They'll be a little bit closer to the target versus the more aggressive, I have to build somewhere, versus the more aggressive strategy, which tries to nail that bottom, hit that support level, and you'll be closer to your stop and further from your target. As we go through the rest of the presentation, keep that in mind with respect to entry. We call them execution tactics, and so we'll talk about those. Yeah, Jim says one more. I've often heard to forget trend lines as they are mostly subjective. What are my thoughts? Yeah, precisely. Not so much, forget them, but don't, if I could stress one thing, it's don't be perfect. I tried that, even with Fibonacci. Anything like that. It's we want things to work out perfectly. We want textbook examples, but the thing that I do for the intraday reports and the idolized trades commentary is just that. It treats the trades and it teaches the trades about what really happened. It takes everyday session and then explains and describes what happened, what went wrong, and what can you learn specifically. And more than not, it's not that perfectionism is going to be the best strategy. It's just adapt, focus on price movement, and focus on supply-demand dynamics. This is going up. Buyers are coming in. This is going down. This is a retracement outcome. And then once it starts to break above, whatever that level is, this is your measured move. It's a rehash or redo of what just happened before. So the fact that it came a little bit under and we just abandoned the trade or abandoned the flag, we don't necessarily want to do that, especially, again, with today's world, with the algorithms and the stop-loss runners and the fund behavior. And, the point is that, as we'll see shortly, traps are a little bit more common than Charles Dow or Elliott or Schabraker, Edwards and McGee, Pring, and all those founding fathers of TA didn't have to deal with as much traps as we do. Okay, so keeping that in mind. Perfection's bad. It's kind of summarizing that section there. Okay, let's go to breakout trades. In breakout trades, in general, the first component, the first concept that we have to know is that price is consolidating. It's trading sideways. If anybody is, don't rush out and learn about this, but if anybody's a market profile sort of analyst, or any kind of price behavior, price auction theory, you would see price impulse and go in trending moves, and then pause and go sideways for consolidation moves, and then resume the trend. So essentially, the concept, and I discuss it in the trading course book too, is that price tends to alternate, or trends at least, price tends to alternate between periods of high impulse or high volatility, which is trending moves, like the flags, right? Pro-trend retracements are a strategy to trade trending environments, and these consolidation or sideways movements. That is a core market principle it's called the alternation principle. So when price is in a consolidation, sort of a efficiency or back and forth, we also call it ping pong. It's playing between these levels, ping pong. I like the ping pong game. Consolidation. The next move should be a breakout, and that is tradable. How so? Again, making it more advanced, Bollinger Bands, I won't talk about them in this presentation, but Bollinger Bands, if they squeeze or compress, that shows that price is compressing itself. Here we go again, those trend lines. You can draw trend lines, wait for the breakout candle, or just an impulse bar, big bar if you don't use candles, and that's fine. If you use volume, look for the market or look for price to push up on high volume or break down on high volume. But either way, volume is a confirming indicator that helps us to see, we talked about traps and such, a breakout that occurs on high volume and high momentum tends to be more likely to continue and succeed and work and generate profit if we join it than if we join a breakout that shows lower volume or not showing a spike in volume, meaning participation or momentum or internals or those sort of things. So that's one way to kind of sidestep a potential trap, is to look for what's called a volume filter, that when you're participating, and the same works for flags too, when you're entering a position into a breakout scenario, triangle, rectangle, Bollinger Band, whatever the case is, look for volume to spike visually. You can easily see it. We'll talk about triangles today, but other ones would be rectangles and wedges for consolidations. This is important because execution's key. And the reality is, on these breakout movements, price can move extraordinarily quickly and leave you behind, and sort of laugh at the other traders. It leaves you behind and laughs at you. Here we go, yay! And this has been happening recently in the S&P, Russell, Nasdaq, and Dow, and of course crude oil as well, crude oil and gold, and the dollar index. Actually, all of them have been doing these big impulsive breakout moves and basically laughing at traders as they keep going because they're not pulling back, they're not retracing. The market's breaking out and trending. So this is why we study these things. If you don't enter quickly, which is on the break itself, you will feel like you're chasing the market. And we're taught not to chase, and we should not chase markets. But there's a spot to enter a market breakout into a potential movement, and once that happens, you've missed the trade, unfortunately. There really is not a spot to join that breakout unless you just sort of close your eyes, hold your nose, and put the buy order in there. And that's something most of us should not be doing. It is often better to get the actual trade on than try to play safe, like I tend to do, or save on slippage. And I've seen it myself, but I've seen multiple stories of traders that wait for a breakout, and they're trying to get these little slippage things perfect. So we all of us like to use limit orders. We don't want to pay up, and we don't have to. But when a market moves through a resistance level, breaks out, so to speak, if we're trying to play limit orders, we might not get filled. So that leaves us having to drag our order a little bit higher. So if we're trading thousands of share contracts, that can be, 5 cents here is $50, 10 cents here is $100, and times whatever, how many shares we're trading or contracts we're trading. So when you're not getting the trade on, eventually you miss the opportunity. So keep this in mind, that it actually is sometimes, depending on your market and your time frame, we're not talking daily charts, talking 1 minute, 5 minute, 15-minute lower frame. It's often better to just sort of bite the bullet and get in with market orders. If you're trying to save $50, $100, $200 on efficient entry, which professional traders we should do, if the position would have made $1,000 and we missed the whole thing, just kind of kept dragging eventually just kind of threw our hands up in the air and said no more. We actually missed out on, say, $1,000 that we didn't have that we could have had when we tried to save on 200. So, don't just go around throwing market orders at on your positions, but in these specific events, breakouts into quick volatile movements, this may be a spot to use those. Tom asks, why not enter on a stop? You can, absolutely, and we'll take a look at that shortly, about now, actually. So the classic triangle, and this is one of my favorite patterns, definitely. Flag is number one, probably triangle is number two. Hence the title of the presentation, my favorite patterns. But it's a consolidation pattern. What we do, classically, using the old school technical analysis, is take the height of the pattern, and we'll show that. It's where the pattern starts. It's the high of this consolidation, bounce around, ping pong action. Take that, add it to the breakout. So again, we're doing some copy-paste stuff. Had a mentor that's called it copy-pasty, so it's just basically copy-pasty, which would be this move here added to the breakout. We'll see that. There's actually two spots to do a stop. Once the market breaks out, once the impulse begins, you can actually drag it to what's called the midpoint, which is right in the middle of this triangle or consolidation pattern. Or preferably, you want to put it on the other side of the lower trend line. You do, from technical analysis, this is kind of going back to definitional basis here, you are required to have 5 points, 5 little touches, just like a trend line. The more, the better. But you should not be calling a triangle pattern something that does not have at least 5 points. And this would be, kind of quickly on this example, 1 point, 2 points, 3, 4, and then here's your down, and then it broke above that one. So this would be a valid 1, 2, 3, 4, and then you can also even call this a little bit, but don't call a triangle something that's just right here. 1, 2, 3. Oh, there. Wait for the market to form this pattern and break above that pattern. So it does require 5 points to be technically valid. This has multiple points. Just for quick, while I'm on that topic, this has plenty more than 5. So on and so forth. 1, 2, 3. It's about 7 or 8. All right. Okay, going back. This is the dollar. Try a couple of want to enter. Okay, let's see. Let's see. Okay, a triangle and wedge. And so a triangle wedge is the difference in what are the difference. A wedge is typically a rising pattern that consolidates toward the highs. It's a reversal pattern more than not. They're a lot more rare than, say, a triangle, which does sort of a little bit of a reversal pattern. So that's kind of the key inflection there. So that's a different distinction. A triangle is more or less a pro-trend or trend continuation trade. A wedge or pattern. A wedge might look like this. If I can draw it. Let's see. Kind of before we go into this, it's a good discussion. So a wedge kind of does something like this. Right? It's still a consolidation pattern. Like that. but the price is trending up, higher highs, higher lows. Higher highs, higher lows. I want to keep this in mind because we'll talk about a reversal trade next in this 3 push pattern. So a wedge, keep this discussion right now in mind with respect to this trend reversal. So a wedge pattern is similar in expectation, meaning a breakout or expansion move from consolidation, but wedges tend to be more reversal patterns, have exhaustion patterns than triangles, which typically are continuation, or can be, at least, more than not, more than 50% of the time, continuation patterns. Okay, so this is a dollar index 30-minute chart going sideways from August, really for the most part of August, and then trading in this 1, 2, 3, 4, 5, 6, 7, 8 spot, and then begins to break above the 8180 level, and therein lies your trigger entry. Look what happened next. If I could zoom in with you, that would be better, but look what happened next. It's somebody mentioned earlier, this big impulse bar. That's exactly what happened and what should be happening, because it is a range breakout volatile activity. Get the position on or risk losing. There is not losing money, but losing time and opportunity. There's not a spot for most traders to get into a breakout trade or breakout event. There's no retracements for that matter, except on the actual breakout. So keep that in mind. This stop would be about 20 cents lower. If the breakout's about 81.80, the stop is about 81.60. Again, not perfect, but just kind of a quick conversational piece. And the height, which is about, this is the top of the pattern. I just drew it backwards. Top of the pattern to the bottom of the pattern. It's about 50 cents in the dollar index. We're going to add that to the top of the breakout, 81.80, takes us to about 82.30. Price went above that. That's okay. Our stop and our exit is done. And the trade has been successful. So these are quick impulse trades. Same thing with a wedge for that matter. Couple more. This is a dollar index again on a 30-minute chart this time, going through September, or going through July, most of July. Similar, this is an uptrend actually. The market's going up, and 1, a little bit of a 2, 3, 4, 5, missed one, 6, 7, 8, so on and so forth. Touches of that trend line. Again, not perfect. This is not perfect, but it counts. So, okay, so the stop is above 80.40, 80.40. And I actually did 2 for you here. This is kind of a little going beyond the basics, kind of doing today's markets, which is this, that you can actually draw 2. Does this count as the high of the pattern? If so, that's 40 cents. And that takes us to here, where the market initially paused on the breakout. If this is the top of the pattern, then it takes us to 50 cents. Either way, both targets were hit in this example, but it's just depending on how this pattern plays out and what targets to play for. Either way, they're both inherent. They're both in the pattern, in the inherent pattern that as it builds. And the stop, once it triggers, is underneath 80.20, which is your lower spot, 80.25, thereabout. So you're playing, if you're playing for 20 cents of risk, taking a stop if it falls under this level, you're playing for about 40 cents of profit. That's directly 2 to 1. You'll make 2 times what you risk. Doesn't seem to be, jump up and down excited. It's not 10 to 1, but the odds are that it will succeed. And same thing, if you're playing for a little bit higher, you're playing for 2.5 to 1. Lee's asking, what are the smallest time frames to use these on? I've done triangles on the 1-minute ES futures. So, triangles are just consolidation patterns and expansion. Your targets, your stops, your activity level is just dependent upon what you're doing. I would not go lower than 1 minute. In fact, I don't recommend going lower than 5-minute charts unless you're really proficient. But, 5-minute charts are kind of my bread and butter, and I use the 1 for confirmations. But, I've done them in my kind of wilder trading days on the 1-minute chart. So that's one thing that's nice about TA, especially basic level TA, is that it's going to work on any time frame, any market. Okay. Wait to see him. Jim says, dang, you CMTs make it look so easy and natural. Goodness, I just spent 2 years learning this, not to mention that, just on my own passion and interest more than 2 years I took formally. And of course, that was back in 2008. This is what, 6 years later. So, trading is a lot of fun. Okay. Well, thank you. I appreciate it. Thank you, Jim. You all can do it too. It's not, you don't have to have all this much knowledge. Just take the basics and build whatever you're comfortable on. I just was a nerd. I wanted to learn as much as I could. So it's not required to be a technical analyst nerd like I am. But anyway, that was funny. Okay, so 3 push. Okay, wow, going back. One more to go. Any questions so far on the triangle? What kind of take the flag at the end? But anybody want to talk about the triangles or have any sort of questions I can clarify? Maybe jump too quickly through something, or any question on the triangle so far? Oh, Tom, yeah. Do we enter on a stop? Yes, I didn't talk about that earlier. Let's go ahead and talk about that now. This conversation also works as a flag. What that means is, do I enter on a stop? A lot of traders that are new, they associate the word stop with this, which is if I get long and the market comes back down, I place a stop. And if the market goes under, it hits my stop loss and I stop out of the position. Right, exactly. But a stop entry, you can actually have a stop market entry. So refer to your broker, refer to other how you trade and how your trading platform is set up to do what's called a stop market entry. Meaning, especially if you are if you are a full-time trader, or have a full-time job and can't watch this tick by tick like some people other can, what you would do is see this pattern forming. Say you're doing your analysis at nighttime, and then you would put with your broker, with your trading platform, a stop market order to enter the position. You can also do what's called a bracket order. And a bracket order, if you think that the market could break up, could break down, not really sure, but you want to take part if it's a really, really long consolidation. The Japanese yen just recently, maybe a month ago, did a really lengthy triangle we were talking about, and sure enough, it broke and trended for quite some time. So a stop entry is just that. You are placing a resting order to execute your position, even though you're not there, or you could be, it doesn't matter. Just the market will pull you in. The market itself, your brokerage platform, will execute the trade on your behalf when the market touches or trades above a certain level. That's called a stop entry. Also could be called a bracket order, but that's actually a very, very good way in terms of execution tactics to enter these type of movements. Because if you're especially, and I've done it too in real time, where I've seen that, I've even talked about it on the blog or something, and watched a stock or market break out, and for whatever reason, try to get the perfect trade on it and just miss the whole thing. So if I had a market to enter or a stop to enter, if it touches it, go above and pulls you in, I would have gotten into it. So sometimes we can be our own enemies on the trading community, but that's an example. So just go ahead and put what's called a stop market, or a market that if touched, it gets you in the position. That way you don't have to sit by the mouse and click that button. And it will be in gradients above. The question is, where do you place that stop? Could be above the prior, definitely above the prior high. These trend lines will descend or ascend, and so you'll put that above the prior high, the trend line, before you go to work or the evening before or whatever the case may be. Even if you're trading full time, you still have the chance to put this in there and kind of walk away, divert your attention, and let the market get you in it. It's just basically trusting that the pattern will work. And of course, not getting too complex in a basic conversation, but once you get triggered in, you can have your platform do a auto stop. So if entered, then automatically at the same time put a stop. But it's beyond the scope of this presentation right now. Okay, can I spell the steps out for the triangle trade? Yeah, the triangle, think of it in terms of recognition. And that's going to be a market that's typically going up or down after a trending move. But it doesn't, like a flag. A flag is a trending market that goes down, retraces, and then goes back up. This could be something that goes up and then just kind of goes sideways. So the triangle trade is based on that. It's an expectation in real time that if the market is consolidating, then the next move, technically, triangles are neutral. They're just expansionary trades. So don't think of a triangle. A flag is inherently directional, meaning the flag should break to the upside, should keep that trend going. triangles, for the most part, should break in the direction of the prevailing trend. Doesn't mean they will, so don't treat a triangle as you would a flag. They're not the same thing. Flags are retracement pro-trend patterns. Triangles are neutral consolidation breakout patterns. They're different. That's why you can put stops on the side. But you're playing off the notion, the expectation that the next move in the market will be an expansion or a trending impulse move. Does not necessarily mean up or down. More, don't bet on it's always going to go up. Flags you would. So recognize that pattern. Then once you have drawn with your hand print the chart out, draw it by hand or by trend line or whatever the case may be, like this. You have at least 5 points that the market touches. Then you are getting ready to enter on a break, one way or the other. Of course, we'll flip it the other way. The stops will go above, target goes above, etc. And we will play for the same thing. A measured move, a distinct target. It's just taking this, and see if I can do it. Taking this movement, the top to the bottom, and aha, cool. Copy paste to the upside, and that is your initial target. Otherwise, this would be your lower target. So, depending on how most of them are a lot clearer. This is kind of a short. This is a real term, real world. Not really a textbook example. That was just kind of recently in the dollar index, and you would play holding it until it hits the upper targets. There was a question earlier about, do I pull up a stop? Sure. If the price, say if this is your target and the price has gone up, in this case about 25, 30 cents, it's up to you. But there's nothing wrong necessarily, nothing hideous or terrible about pulling your stop from this spot, pulling it up to the middle of your target. Nothing wrong with that. Certainly not. So you're going to exit, which you can also do an exit on touch on the target. You can place it in events, or monitor the position with your own hands, with your own experience, as it goes for the target. So that's it. A recognition, 5 points of a consolidation, breakout entry, target's inherent, so is a stop, and then the rest of it is just playing toward the target, maybe pushing up that stop if you so desire. And that can be helpful for new traders, certainly. At least builds confidence, and playing from there. Yeah, Jim says very similar to what I read in Edwards and McGee. Definitely, but the same thing. A lot of times you want to be on guard for traps. That's why that stop should not be kind of hugging up or snug up against that trend line, because a lot of times it'll come up. And this one did to an extent here too. If I take all the stuff off here, so we can erase them all, and maybe not. All right, so kind of picture with me, if you will. This has broken above the trend line, came back down, broke up, came back down, and finally, this actually took 2 pushes above where the trend line was drawn to get in there. And if your stop was in that spot, you got hit. So that's why a little bit larger stop is better, because again, what's different than what did Edwards and McGee in their world in the 50s, 60s, 30s, 40s, whatever, what did they not have? Computers for the first part, algorithms, hedge funds, etc., Twitter, stock twits, trader education where the public can take day trading. They didn't have that back then. So there's a lot of factors in today's markets that are in many ways advantageous, other ways a little bit more volatile, choppy, trappy, that they would not have had. Besides they would make, I wasn't sure about that. I know there's some scandals about Gann, WD Gann. I wasn't sure about Edwards and McGee though. I don't know their life story and how they did all their stuff. It's a very, very cool textbook though. Okay. Yeah, Apple definitely, one more. I blogged about this one recently. Apple is certainly, if you want to see a real-time triangle, it's up on my blog, and it's still going on, actually, in the chart process. Apple, AAPL, go look at Apple on the daily chart. That's a crystal clear triangle taking place right now before our eyes. So test out if this thing works or not. All right, Ray Push, one of my favorites, my third favorite. As a professional trader, I've been doing this since 2007 full-time now. I'll just kind of be personal here. I've kind of turned away from this whole reversal style stuff and gotten more towards pro-trend stuff. Maybe that's a factor of, in 2008, the market went straight down, and 2009 to present, the market went straight up. So maybe the whole reversal thing isn't really my cup of tea, or in fact, the market's cup of tea anymore. But, this is short-term traders. Certainly, this happens on a daily basis or swing trading, or sorry, intraday basis. But you're trying to call that top in that mean old S&P and Russell and Dow, and that's probably not your best strategies here yet. But pro-trend things have worked. Market environment dictates what we do. So we need to have these in our toolbox, and already we have a flag, pro-trend retracement, a breakout consolidation triangle, which is a neutral style breakout impulse type trade, and finally we'll talk here, which is a aggressive, I will always call it aggressive reversal pattern. So a lot of new traders are drawn. I was too, to an extent I still am, because it's sexy, it's fun. Call that top, call that bottom of the market, get in there and make a bunch of money, tell your friends, get on Twitter, and that kind of fun stuff. But in the reality, you'll make much more money consistently, more than not, by going with a trend than against it. Anyway, that being said, there is a spot in your trading toolbox for reversal trades. This is my favorite. That and the head and shoulders. Anyway, this is a 3 push pattern. You may have heard Linda Raschke, I think she calls it 3 little Indians. I actually learned this from Larry Pasavento. He calls it 3 drives to a top. Larry Williams, the list goes on and on. I don't think Edwards and McGee used this pattern. They called it something different, if they even called it that. And Dow, I don't think ever talked about this. But nonetheless, this is what's considered a 3 push pattern. Push being equal swing. So inherently, push 1 you won't be able to see in real time. Not going to happen. Push number 2, probably not. And these are actually, what are these called? What's this? Here's kind of a cool little integration. What's that? That's a flag. That's a flag too. So as you go through this 1, 2, 3, they're equal measured moves that may or may not form bull flags. By the time you get up to number 3, the market's pretty much done its thing. Supply-demand differential is strong. The bulls are taking profits. Bears are salivating and ready to get short. And so this is a loss of momentum, a reversal play. Still very aggressive. So look for a loss of momentum on volume. Market internals. Again, being basic, you don't have to do that, but it makes it a little bit clearer and more probabilistic if you start seeing price push up and other things. This is the 310. It could be rate of change. It could be even a rate of change indicator, all those sort of things. Market internals, volume, doesn't matter. Just that it's forming lower highs when price is forming higher highs, and 3 of them, for whatever reason, tends to be a high probability pattern play. And we're going to enter on the break of a trend line, which you can draw that. My goodness, how many times we're going to talk about trend lines. You can also do at the top, if you're a proficient trader, that's again an aggressive move. Nevertheless, just wait for the break of the trend line. This is a gap scenario, but anyway. So the stop is above the 3rd swing up. Target, here's where it gets fun. You would target a retest of the start of the pattern. That's where the market began its initial first 1, 2, 3, done. And in this case, it was there. This actually took about 1, 2, 3, 4, 5 or 6 days to get there, 1 day to get to the bottom. So reversal trades can be violent even if you're correct. So it's more or less, if you are a new trader, treat these as don't buy this flag after the 3rd pullback. So you can think of it that way too. Look for a lengthy uptrend. Look for those divergences, which is an indicator making a lower high with respect to a price making a higher high. And indicators can be in any form. It doesn't have to be the 310 or the volume. Volume is probably easiest for most traders. Just look at volume. If this is volume, see lots of volume here, a little bit less volume there, a little bit less volume here, my goodness, don't trade that pullback. Don't go with the trend. Doesn't mean you have to go short, but you can. That's the probability at least. There's that upper Bollinger Band again, maybe. Higher time frame resistance if you're trading, say, a 5-minute chart, and you get a 3 push or a divergent pattern into, if this was, say, S&P 2000 or Russell, 1200 or whatever the case may be, that's something to take advantage of as well. That will be an aggressive get in that short, put a tight stop, and play that for a little bit of a higher swing trade. Or if you do candles, look for these cute little things like engulfings, dojis, hammer, shooting stars, dark cloud covers, all those fancy names that just mean bears are starting to take over the supply-demand relationship. Going back to July. Okay, one question. If you're in the impulsive move, do you get out once there is a flag or stay in, anticipating a breakout? Let's go back to the definitions. If you're on the impulsive move going up, I suppose, do you get out once there's a flag? There's not a one-size-fits-all. If you're trading a flag, yeah, your target is going to be this. So if that's your flag mechanism, you're going to go ahead and get out at that high. So you wouldn't even get into this pullback. Your target's hit, and the same thing goes for this one. If I can sort of draw, there we go. Perfect. I can just take that drawing off. Same thing with this flag. If you're doing this as your flag parameter, if you're trading a flag in a pro-trend environment, going with a trend, there's your target, you're out. So yeah, you're specifically trading for a target, specifically trading for a level, and once it's hit, you don't keep the party going. Once it's like midnight and people are starting to leave, it's time to get out of that position. So you want to go ahead and exit if you're playing a flag. And so I mentioned earlier, on this one, you don't want to start calling a flag. You don't want to start getting long. It's still a flag. It's definitionally, here's an up, down, but there's something different about this flag. A, it's in a mature, lengthy uptrend. B, it has divergences, maybe volume momentum. It's got big reversal candles the other ones don't have. Starts the market structure's falling apart. And again, it's a classic going back 20, 30, 40 years, which is called a three-push pattern. So the odds, we'll put it this way, the odds are quite reduced of the flag working. Odds are stronger if it's a first or second flag, not a third flag. How do I know when to get out of the flag position? If you're a new trader, you're only going to enter on the break of the trend line. If you're an advanced trader, you'll go ahead and, this got you in a lot of trouble because this is a gap down. So that's not much we could have done on this one. But as you'll see shortly, take a look at the examples, this is the Russell futures 60-minute chart going back to June and July this year. So it's an uptrend. Here's a bull flag. And so that push is a sustained move, by the way. This is a sustained move, continual move. Takes a couple of days to go through it. This is push number 1. And push number 2 is a little bit, you're losing momentum. It's still going higher, but you're losing momentum on the pushes. And push number 3 goes up with a candle, starts to break a trend line. And this as well has an aggressive, there's the Russell 1200. I mentioned that earlier, right? So this is an intraday pattern into a higher frame known, we call these round number resistance levels. So here's a boom, boom, boom. Here with a divergence, 1, 2, 3. That's a spot to stop trading long unless it goes above 1200. And if you are so of the mentality to do so, which is to get short and go against or fight a trend, if you are that bold, this is a valid and quite probabilistic reversal play. New traders, I don't think, should be doing this. They should be waiting for this conservative break or this aggressive, meaning it is steeper trend line. Price broke it. There's your stop is tighter above 1200. That's your aggressive short sell. Otherwise, we broke this trend line here, which is about 30 points, 40 points, 30 points lower. Still far away. I get that. That's price has already moved down 40 points. Where's your target? Your target's going to be the start of the pattern. That's just above 1100. So the thing still got its target, but risk-reward basis, it's better to try to get into the high than not. So, but there's no guarantee that a third swing won't become a fourth or fifth. That's the big joke about Elliott wave sometimes, which is, there's your 1, 2, 3, 4, 5, 6, here we go, 6, 7, 8, 9, that kind of thing. So, Elliott's wonderful, but it's a contra-trend strategy for the most part if you are using it to call fifth wave tops, or in this case, fifth wave tops, 7, 8, 9. So that's why we don't just walk up and say, there's 3 pushes, we're short. Or there's an Elliott fifth wave, we're short. That's not the way the market typically works. You want to wait for confirmation in the form of trend line breaks and breakdowns to let us be confirmed that the bears, especially this violent move down, are becoming more active. And we'll join in, place our stops, and play for the target, which is the prior low, or when the pattern started. 1, 2, 3, and out. Similarly, this is going back a little bit, kind of want to show this on the opposite side. There wasn't much to do in the dollar index if you've been trading it lately on the downside, but I did want to show you for the presentations factor a downside reversal and upside play. So they've got the same thing. So even though this is a big down move, you're really going to start the pattern on this little retracement, this little spot there, 82 on the index. 1, I drew it out for you. 1, 2, 3, positive divergences, reversal candles, initial movement up. There really isn't a trend line. You can't really do this at that point. I mean, you can, but that's not that valid. So we'll just go ahead and play for an initial target, just shy of 81.5. That got hit instantly on your aggressive entry, going up here, off the low, off of 80. Now, by the way, same thing. You're into higher time frame support level at 80 on the index. But like I mentioned, it went just a little bit up under that, beneath it. That's a trap. That is a trap because it hit this level, came up off, and it went under it, and then reversed back above it. So that is a trap that went underneath the level, stalled, and came back above it, and trapped the short sellers. Nevertheless, the conservative or small target was about 81.4. The full target, which eventually got hit on a gap actually twice, was 82. $2 move for about a 20-30 cent stop in the dollar contract. What's that? Yeah, exactly. Ted says, Elliott, going back a little bit, he's got the question here. Elliott wave algebra. The wave is whatever number works after the fact. I will make a comment about that. I just kind of chuckle to myself. Anyway, the 3-push pattern here, one more example, and we'll open up for general Q&A, is, and this is kind of a cute little example, I thought. This is going back for the Russell at the start of October. So this is a down move. Again, same thing. Do we start here? No, that's not really a unified swing, at least for this purpose. A unified swing is from 8 retracements. So boom, that's 1, that's 2, and that's a flag, not your perfect flag, not a flag I would trade necessarily because it's really not that flaggy. It's just very choppy and volatile. But anyway, so 1, 2, 3, about the same size swings. They're equidistant swings for the most part. That's what you're looking for. You're not just looking for just random things. You go 1, 2, 3. There we go, 3. No, it's equidistant or similar swings, just like a flag. There's a reason we target these movements because that's how those patterns play out. So the break above this, it's in the Russell here, 1075. Nothing special about that level necessarily. And then going up, there's your impulsive candle. It's that same concept of get that trade on because as traders, here's something else that Schabaker and Edwards and McGee and Dow and Martin Pring, I even throw him in there for a recent technician, John Murphy, et cetera, et cetera, et cetera. Well, Murphy now, but anyway, back in the before computers, they didn't have this concept of Twitter or stock twits or all the time all the time in your home news. The financial networks are constantly on the air. Twitter's always there. And Twitter and these sort of things create instant action, instant information. And there are a lot of people, myself included, that put trade concepts or trade ideas out there. And to the extent that people follow those trade ideas, it actually creates movement. It actually creates price to do what the trader, analyst, or whatever the case may be, is either on TV saying or in Twitter or stock twits or what have you. Those can actually, in today's market, create movement that would not have been happening, would have been possible in any sense of the word, even before email, for that matter. Just think about how far we've come. So the point is, get that trade on. Don't hesitate. Don't stall. Plan, wait in advance, and then get in that position. And if you miss it, this is what happens. It's these powerful, impulsive things that do exactly what you thought they would do, but you're not in the position. So this does take a little bit of, it takes a lot of confidence, and experience to do that. Here's what's cute about it, and there's a little tiny 3 push going into October 3rd. 1, 2, 3. I wouldn't necessarily trade this, not so to speak, because it just happened so quickly. It's a 5-minute chart, but nonetheless, 1, 2, 3, done. And the Russell reversed into that level. I thought it was kind of cool to show you. All right. Today's markets, we've already hinted about it a little bit. Algorithmic traders kind of starting at the top, and it's all that text. We'll kind of jump through it with me. Algorithms are speeding up, and there's lots of data on this. I won't go into it now, but it's speeding up trading activity, volatility, quants, meaning computers. So these are things our founding fathers didn't even think about. They didn't even know what a computer was. It increases the probability of a trap, but it also increases the probability that you're going to get a very, very rapid movement off an obvious, very obvious level, like the Russell 1200, like the S&P 2000, et cetera, et cetera. So it's kind of a double whammy there. It creates more volatility, but at the same time, once you get a position on, in the past, maybe you had more time to play it out. This time, you're in or you're done. You know, you missed it. Too bad. You go to the next opportunity. So that is a little bit different. I kind of hinted at it. Information ideas spread instantly, and by instantly, I mean instantly, by Twitter, which I love Twitter. I'm a huge fan of Twitter, just consuming information and also providing. But you can just follow people and figure out what they're doing, what they're talking about, or what they're trading sometimes, and jump in. And if something happens big on a particular stock or the market itself, jobs report or Fed report or whatever, it's going to be reflected in the price quite instantly. TA can help you step outside of that, you don't have to put your headset on and constantly be with news, follow the pattern, trade the impulse, etc. For some clarity. That way you're not as confused by the chatter. So TA and his patterns can help you step outside of that, but you realize that creates more volatility and what's called self-fulfilling prophecies. There's so much trader education. Trader Kingdom is wonderful. There's dozens of companies that provide education and books and webinars and seminars, good and bad. Some of them just throw up something random and try to get a bunch of sales. That's not good education, but it's out there. Some of them that are really good you may have never heard of. So there's just a lot, and so you do want to be careful about what you expose yourself to as traders, and you can feel overwhelmed. I'm dismissive and teaseworthy of Elliott Wave as I've become more professional, but in the past, I thought it was great. So we all have our journeys of things that we learn, we like, we don't like, that's in favor, that's out of favor, so on and so forth. So, that's just a kind of a general comment that, choose your education wisely, but don't be overwhelmed. That can happen too. Oh, there's 1,000 books out there, and et cetera. Get a core and build off your core. Presentation. This is a whole other presentation with the intervention of the Fed, central banks, what's called this crisis response, which is this other kind of thing that we're in. Crisis. Debt ceiling, we're going to fall apart. We're going to lose our credit rating, and all these awful things that are happening in Europe and in Middle East, and now we have the Ebola and all the government shutdown. You can just keep going on and on and on. But we're much more involved in headline news, and that drives market prices now. Anyway, all it's something to be the willingness to play the failure outcome from what's expected. Don't be biased. Don't say, well, Corey said a triangle has to do this, therefore, and it's not doing it. Well, no. In today's markets, it's just sometimes the failure outcome is which you have to know what the expected pattern is and when it fails, and decide whether to take your stop and be done, or to play that bigger move. Because, just our presentation here, but in general, if something should happen but doesn't happen, it tends to lead to a larger than expected move in the opposite direction. That's because traders who get education and who do the basic things, which is nothing wrong with that whatsoever, but when patterns fail, those same traders on an aggregate basis, they get trapped. And sometimes I'm trapped with them. It's just you put a position on, and we're all kind of loading the boat or whatever, and something else happens, and we all have to get out at the same way. It's like the whole fire in a crowded theater. If everybody's in a small room and there's only one exit, it's going to be quite nasty. And what that means for us in today's markets is that be nimble, be ready to play unexpected movements, take your stop and consider whether you can join in on that bigger move, because you can actually make more profit when the market does a failure outcome. That's, again, a topic of a whole other presentation that I've done before. Anyway, and the same thing, easy access to multiple markets at any time. It's just a click of a button, type of a couple of keystrokes, press of a mouse button, and you've got access to whatever you want, whenever you want it. You can trade whatever you want, assuming you have your account, margins in place and your permissions all ready to go. Options, futures, forex, overseas ETFs, etc., etc., etc. Meaning, you're going to get information overload, and focus on things that work for you, focus on time frames that work for you, focus on markets that work for you, and build on success, not on just jumping around. Okay, so we'll open up for Q&A. Yeah, come on, the Chicken Little sky is falling. Not. And intention creates expectations. For sure. And again, I'm the product of trader educators like myself at this point, so I'm honored to be here giving the presentation, just sharing a little bit of what I learned. Again, I'm happy to contribute back to the community. So email me any point in time. I'm the product of emailing other trader educators. What is this? And bouncing ideas off of them. They were helpful to me, and I'm happy to be helpful to you. So I'm contacted directly at Corey@afraidtotrade.com. Otherwise, afraidtotrade.com, the blog, and on Twitter. And as Paul mentioned, you'll get this free month to get inside my brain. And it should be really cool. Things going on this month here in October. So you'll get a little free month of some insider analysis and strategies and planning, when it could be very interesting. So we'll go back to Paul and open up for questions as we go through here.
Great, thanks.
Yeah, Peter. Go ahead, Paul.
No, I just wanted to jump in, and I know there's a lot of questions. I don't know if you have some more time to stay on still. I know we've gone past 4:30 here, but I know a lot of people are still with us. So if you still have some time, Corey, to keep going, or what do you think?
Yeah, couple more. Real quick, any software can be used to look for trading opportunities. Yeah, any software. A lot of things are prolific on that. So Ninja or the other brokerage, even stock charts, things that are free, things that are paid, look for opportunities. And especially what I did specifically for this presentation was focus on price patterns that should be applicable to anything you can pull up there on the charts. On the TF 5-minute, it can move 35 ticks or more. What kind of stop should be done for a day trader, which opens up a big discussion. Stop losses can be placed at can be placed on trend line levels or patterns. They're inherent, but because I mentioned the traps and because I mentioned the new dynamics of the new market, you probably want to use what's called an ATR function, which is average true range. And so what you want to do is when you're putting a position on, right, there's times when the Russell can move 35 ticks, which is a lot. Can be quite volatile. This week has been a volatile week. So your little 10-cent stop isn't going to be the same as this week as in a low volatility week. So the ATR, average true range, meaning you just put that on your chart, and it tells you the average true range of typically the last 14 bars. And so when the market's volatile, the ATR will go up. When the price is less volatile, the ATR will go down. You want to make sure at all points in time that your stops are at least 1 ATR. If the ATR is 10, your stop should be at least 10 ticks. If the ATR is 15, so on and so forth, you probably want to do even more than that, meaning double it. If the ATR is 10, make your stop at least 20 points but from your entry. So think of it that way. You're just basically adjusting your stop automatically by volatility. And the best way to do that is ATR, average true range. And Ross asks, do they work on range charts? Okay. As long as the price, maybe not as good, I don't think, as a pure price, it doesn't necessarily take time into account, but the range is a high, the low. You want to see what the bars are. So every 5 minutes, every 15 minutes, it takes a recording of the high and the low and those sort of factors and plots them out. It averages them, by whatever the setting. I think 14 is default. Maybe 20, you can change to that. But, I would do them on regular charts and just have that value and plug it in. You don't have to have you don't have to see the indicator, just have the value. If you're a day trader, if you trade the daily chart, that's not going to change as rapidly as, say, a 5-minute chart will. So if you are playing entries into markets or stops, etc., just if you're a worker, full-time worker, I'm not a full-time trader. Yeah, just at least plot the ATR, write it down, and have your stop at least one average true range away. And the Jim says, you say trading the trend is the most reliable. Your thoughts on using Ichimoku? It seems to put a trader rather late to the point. You know, there's a lot. Ichimoku is something that's come up since I got my CMT. At least has become popular and proliferated since I got my CMT. So it's sort of like a doctor that's learned, you know, medical techniques and medical surgery things, and then something else comes along. Now, I'm not saying that Ichimoku is a new thing. It's not. But it's not something I had my attention on. It's something I've traded with or researched. I know people that do really well with it, but I'm not one of them. So I just don't. If I learned it, studied it, used it, that could be so different. But it's something I have not done. And as a trader, even the trader educator, nobody can do it all. So I'm probably not the right person to ask about Ichimoku. They could be the best thing in the world, but something I've not come across. I tend to be a purist. I tend to be a price purist, pattern purist, and trend purist, and focus on those things. I tend to keep it really, really simple because I got really complex with respect to the CMT. I learned all this Elliott, learned all this Fibonacci, learned everything that was wonderful that I still at times use, but I actually saw a decrease in my trading performance. Trading profits went down, and the reason was I was looking at this and trying this, and you know that didn't work for my core, and I went back to this kind of stuff, trend lines, and price breakouts and patterns and confirmation, non-confirmation, and things started to get better. But I'm not poo-pooing any type of method. It's just what works for you, and focus on those. And that's just true for anything, anybody for that matter. Let's see. Yeah, again, a couple questions. Yeah, this will be archived. Okay, we'll go back to this is a couple more questions. I mean, it seems to be good. We'll go back to Paul, and again, thank you all for attending. I appreciate your great attention and questions, interaction. That's made it much more fun. So thank you. Be safe, and we'll see you again.
Great, thanks, Corey. And as I mentioned up front, we're excited to have you come in and join us this afternoon in another great event. So thank you for the time and the effort that you took putting everything together here today. And again, thanks to everybody out there for joining us. Hopefully you enjoyed the event. I know the comments and feedback have all been really positive coming in, and obviously a ton of questions. So thanks for helping to keep Corey on his toes. But as we're wrapping up, Corey mentioned we did record the event. We'll be sending out an email tomorrow morning with a link to that recording. Also, Corey has up on his screen, and we have the link in the link box on the left-hand side of the screen. You definitely want to take advantage of the free month of complete member access with Corey. Daily educational lessons, market recaps, strategies for the next trading day. Obviously, a lot of great information to take advantage of through the free full month trial, and a great follow-up from the introduction that Corey gave today. With that, we'll sign off for now. But again, a big thanks to Corey. Thank you to the team over at ICE for joining us as a co-sponsor of the series. And we've got the link to the ICE market commentary, weekly updates that are available. The links on the left-hand side of the screen, the ICE market commentary box. Definitely want to check those out every Sunday night if you are not already. Those are focused on the U.S. equity and the currency markets. And then also we've got the link to email ICE with any questions you may have regarding their contract specifications, anything along those lines. So feel free to email ICE directly with those questions as we're finishing up. But again, we'll sign off for now. Thanks to everybody for joining us. Hopefully you'll have a chance to join us for another event in the coming weeks. We have part 2 of our Technical Traders Forum series scheduled for next Thursday. Nick McDonald from Trade with Precision will be joining us. Nick and his team prepare the weekly ICE market commentary recordings. So if you check out those recordings on a weekly basis, you'll definitely want to join us to get some updates directly from the source, from Nick, during that session. So hopefully you can join us for that. But until then, we'll sign off for now. Have a great night, everybody. Thanks again, and we'll talk to you soon.